When it comes to stock market corrections, it's different for people in their 50s and 60s because they've got shorter timeframes to consider and less money to invest into the stock market to help their finances recover. In this video, we're going to look at how you can combat stock market downturns, and we're going to look at 3 case studies, one of a retiree who's just looking at total returns, one of a retiree that has a dividend portfolio, income portfolio, and the final one is someone just about to retire. In retirement, it's important to avoid dollar cost ravaging, where you sell assets at a price much lower than you want to, and then your wealth won't recover because you've sold the very assets that you'd need in order to get your wealth back in line with where it should be. Now, retirees can potentially limit this by looking at the assets they choose to sell when they're drawing down. So, for example, they could have a cash buffer. They could sell from an ISA and then there'd be no tax implications. And because they're not paying the tax man any money, then they're selling less units in their investment funds, or they could take from their pension, which would potentially be 25% tax free. In terms of cash buffer resources, they could use a money market fund. There's an ETF CSH2. There's also an ETF from JP Morgan. And then there's also a money market fund from Royal London. And they can use short-term UK government bonds called gilts. And a popular one at the moment is TN28. So they could have 3 to 5 years of expenditure in this cash buffer, and they could draw on it if they felt that the stock market was quite weak and they didn't want to sell at such low prices. So one of my pet hates is when people say you can't time the market. It would be more accurate to say you can try to time the market, but it might not work out for you. Essentially, retirees are kind of timing the market because they're making an assessment of market conditions and then deciding whether to sell like equities to fund their retirement drawdown or whether to use their cash buffer because they want to avoid being a forced seller of equities. And it might be possible that those working could even look at some simple market timing to make themselves better off. So some people naturally trade their portfolio. And if you've never done that, then it's probably not a good time to start. If you survived the COVID crash by not reacting at all, then that's probably a good way to proceed in all future crashes. But if you are tempted to tinker with your portfolio, then there are some things you need to bear in mind. You need to avoid selling too late into the decline after essentially the ship has sailed. So if you're already about 15 to 20% off your all-time high, then you probably just got to sit on your hands and do nothing. And then similarly, if you do sell, you've got to make sure that you don't leave it too late to buy back in, because prices tend to move around expectations rather than maybe solid news flow. So like when the COVID crash happened, I was waiting for a vaccine to come along and then I was going to buy back in. So although I timed the sale okay, I was way too late in buying back, and that really impacted my portfolio. So Vanguard would call me a cash panicker, and they did a study on it that proved that people with Vanguard accounts, if they sold and bought back in, they ended up worse off. And then the other thing to watch out for is what asset you choose to buy when you do re-enter the market. Sometimes people can do things like sell the technology sector and then buy something like consumer staples that they think is more safe going forwards, when actually consumer staples is on a different market cycle, and you could find that that sector declines just as technology starts to rebound. So you could be compounding your errors if you buy into the wrong asset when you re-enter the market. So people in their 50s and 60s can react to market downturns through diversification, but that's really tough because, for example, bonds can fall in price at the same time as equities if there's high inflation or rising interest rates. and long-term bonds are almost like a leveraged play on what's going to happen to interest rates. So you can have some quite wild swings in their prices because you've got 20 years worth of an interest rate impact to consider. Then you've got real assets like property or infrastructure, but often the underlying returns on these assets are low, maybe 3 or 4%, so potentially below the risk-free rate of return. So what happens is they leverage up these assets with debt so that then they can have a high dividend yield and it looks great to investors. But if interest rates then rise, then the debt becomes a problem and the company might have to sell assets to pay future interest bills, or it might have to lower the dividend payments. Commodities tend to just bounce around all over the place, and then gold, which is seen as this safe asset. I'm just worried that maybe behaviors might change over time and that youngsters don't really see it quite in the same way. And then also it's currently very expensive, so it would be quite a brave person to start entering the gold market right now. So rebalancing used to be equities and bonds, and you'd essentially be selling equities at a high price because they would have outgrown bonds if there was a bull market, and then buy bonds at a low price. And then when there was a natural stock market decline, you'd have a lot of bonds, their price would potentially go up, and you'd then sell the bonds at a high price and rebalance back into the lower priced equities, and it would be great. And this combination could mean you could potentially outperform if you hadn't done any rebalancing. But in the last about 5 or 6 years, that's just not been the case at all. And it seems like the only real way to survive the market correction has been to have this cash buffer. So someone with an income portfolio leaving off dividends will initially see no impact from a stock market decline because their dividends will be intact and they're not so fussed about checking the value of their assets on a daily basis. However, it might be the case that in the future, maybe 12 months or so down the line, they will potentially see dividend cuts because the tariff increases will impact their underlying investments. And you've still got to be careful because there are a lot of yield traps out there that will eventually be uncovered. A possible solution is to look at some of these investment trust dividend heroes like Merchants Trust or City of London, where they've grown or maintained their dividend for the last 20 years or more. However, the increases of dividends for these companies does not match inflation, and often it's only about 1% or not even that. It does mean that they've got reserves to ride out most storms, but then also it means that in retirement your purchasing power is being eroded if you're just living off the income of these investment trusts. So it's kind of a partial solution. There is still risk with it, but it's sometimes delayed. When I'm evaluating a fund, I like to use the measurement returns over maximum drawdown. And that looks at the gap between the peak of the fund price and its trough. So how much does it decline? And then also how long does it take to make a new high? So I'm looking for resilient funds that don't pull back that much. And when they do, it doesn't take them that long to make a new high. And sometimes what I'm doing, it feels like Edison with his light bulb, because I keep finding out what doesn't work. And then eventually I get left with some things that are pretty robust. I mean, an example is the Wisdom Tree Global Quality Dividend Growth, where the problem with quality is that you can have some very high PE ratios for companies that have good profit margins and strong balance sheets. And so when there is a market downturn, we get PE compression, and something on a PE ratio of 50 could move to a PE ratio of 25 and yet still be seen as pretty expensive. Whereas if something was on a PE ratio of say like 12 to start off with, then yes, it's going to go down a bit, but ultimately not that much. And that's why we're seeing quite a lot of resilience in the UK market at the moment. But with market cap indices, you will always have the winners, even if those winners are a completely different set of companies to what was in the index 5 years ago. And what we could do is re-examine our US exposure. There's now an ETF that is developed world ex-US, that's much easier to get exposure to like Asia Pacific and Europe. You don't have to hold separate ETFs in Switzerland, UK, or Canada. So we could do that, have the US alongside it. We could also have maybe an S&P 500 equal weight ETF, and then things like Nvidia will only be 1/500th or 0.2% of our portfolio. And so over time, I start to learn what seems to work for me, and I get more and more confidence in my portfolio. And I'm not really impressed with active funds, as they tend to be slow at taking profits and adapting to new market conditions. They tend to want to be this long-term buy and hold, which is essentially just mimicking what a tracker would do anyway. So I can't really find many or even any examples of active funds that have, say, sold out of Nvidia and then maybe rebalanced the portfolio into something more resilient. For the case study of those who are about to retire, well, it's clearly important to build up your cash buffer so that you avoid an adverse sequence of returns risk in the first few years of retirement. But it's also important to focus on things other than money, because if your finances have taken a battering and yet you still want to retire, it's really a question of redefining retirement and saying, well, it's not about doing no work whatsoever and having no income other than what my investments can produce for me. So you could have a meaningful hobby in retirement that could potentially bring in some money, or you could help others and earn money in the process. I know someone who lives in rural Wales, and he's a supermarket driver on a Sunday. Maybe he's Morrissey because every day is like Sunday for him, but he's able to help people out and make a bit of money on the side. I mean, my grandpa, he got to know a local businessman, and he would do driving for this businessman, just in terms of like a 0 hours contract before they even existed. So he'd just get a phone call, do you want to go to Swindon tomorrow? And if he was free, he'd go, and if he wasn't, then he wouldn't. And it was all quite straightforward, all quite relaxed, and he could either be enjoying himself doing his hobbies or getting a little bit of cash on the side. So it's important to fill your time in retirement with meaningful activities, and then you'll be less concerned about how much money you have. You need to have passion and purpose, and you need to see wealth as an enabler for what you want to do, but it's not the driver, it's not the sole thing to focus on. So for example, you could be really into motorbikes, and you could either go around New Zealand on a Harley or BMW motorbike, or you could scale things back and just go around the UK if money wasn't that great for you. But then also you could fix up other people's bikes, and you could monetize your hobby a bit as well. There's all kinds of things that you could fall back on other than just your portfolio. So ironically, now could be a good time to look at your portfolio and to maybe streamline it to test for resilience. Not necessarily saying sell funds at the bottom, but at least look at what you've got and whether it's actually working for you. It could also be a good time to build a wealth plan, because if you start a wealth plan at the top of the market and then you say, well, I'm going to get an average of, say, 5% growth year after year, then you kind of end up with this stairway to heaven, and your wealth just goes completely off the scale, which isn't really that realistic. But if you're starting from a lower base point, then it's easier to see that, yeah, from this point, I can see the growth into the future, and you get a bit more confidence in the plan. If that interests you, then you can watch this next video, or you can sign up for my newsletter at my website, ianshadrack.com, or check out my retirement calculator spreadsheet.